Hi friends, today we will be reviewing some of the basic concepts covered in the chapter 8 of the Introduction to Business course book. The last chapter of this course is about managing the financial resources of businesses. So today I will be emphasizing main decision fields of business finance, identify main functions and types of financial markets, as well as basic tools used by finance managers for short-term financial planning, together with the tools used for long-term financing. I will also be describing some of the techniques used in the capital investment decision making, and also distinguish various types of financial risks. I will be stressing how financial decisions influence shareholder value, and lastly, touch upon some ethical concepts in financial management. So this is the outline of this chapter about managing financial resources. Before we begin, I must remind you that the ultimate goal of businesses is to increase and maximize the wealth of the shareholders. So businesses try to create value to increase the wealth of the shareholders who invest their capital in the businesses. So managers must manage the resources of the businesses efficiently and effectively to accomplish the goal of the business. So we can classify business decisions in three categories as investment decisions, financing decisions, or operating decisions. So managers make some investment decisions in line with the strategies and economic analysis so that they can create value for the business. Financing decisions are decisions related to how to finance the assets of the company, the investment projects of the company. So businesses usually employ internal or external funds to finance their investments. Operating decisions, on the other hand, is about employing the resources of the businesses to generate profits. So business managers, especially finance managers, make their decisions related to financial markets. So they make some investment decisions and financing decisions and operating decisions, and these are affected by the financial markets they operate. Financial markets are institutions and procedures which facilitate the transfer of funds through financial transactions, and they help to channel funds into profitable investments from surplus units to deficit units. And they also help determine the price of financial assets, since the demand and supply for financial assets come together in financial markets. They also provide liquidity for investors. For example, when a person buys shares of stock for investment purposes, he or she can sell this investment and turn into cash thanks to stock exchanges. And also, financial markets create assets with different risk levels for different type of investors so that they can manage their risks. We can classify financial markets as money markets or capital markets. Money markets are markets where short-term securities, short-term financial claims, or assets are traded. Financial assets are claims such as bonds and stocks, shares of stocks. In money markets, short-term financial securities are traded, whereas in the capital markets, long-term financial assets are traded. By long-term, I mean assets that can be converted into cash in a longer period of time, namely longer than 1 year. So, for example, stocks are traded in the capital markets since they have no maturity, or Corporate bonds which have a maturity of longer than 1 year are traded in the capital markets. We can also classify financial markets as primary markets or secondary markets. Primary markets are the markets where initial public offerings of shares of stock or bonds are taking place. So they are offered, those assets are offered to the market for the first time. However, in the secondary markets, the securities which are already traded, so currently outstanding securities, are traded in the secondary markets. So, for example, when you buy a share of stock, some shares of stock in Borsa Istanbul, that means you are making a secondary market transaction. It is important for companies to manage their short-term cash flows and short-term assets. So we call this working capital management. Working capital management includes current asset investments of the firm. Working capital includes current asset investments of the firm. So managers should wisely manage their cash, accounts receivable, stocks, those investments which can be converted into cash within 1 year, because these are the assets. These are the assets which are mostly used to pay for the short-term financial obligations of the company. So it is very important for companies to maintain a proper level of working capital so that they don't become insolvent. In working capital management, managers usually stick to the self-liquidating principle, which is mainly about financing temporary investments with temporary sources, while financing the permanent asset investments with permanent sources. There are and companies also should plan for the future to predict their future financing requirements and prepare for future needs. So there are some tools to help managers plan for the future. So these tools are mainly pro forma financial statements, namely pro forma income statement or pro forma balance sheet. And another important tool is the cash budget. You know, a budget is a plan to show how much money a person or a business will earn and how much they can spend or they will need if there is any deficit. We should also be talking about the long-term financing need of the company. So when companies need to finance their long-term investments, their long-term assets, they have to use some tools. In fact, companies prefer to finance their long-term assets with long-term sources such as trade credit, leasing, bank loans, or they may issue some securities such as bonds or shares of stock. Trade credit is the credit extended by suppliers to their customers for a long time, especially when they sell fixed assets. Whereas leasing is a contract to finance machinery, equipment, and other fixed assets in the long run. When companies purchase those fixed assets, they may sign a leasing contract so that they can finance this investment by this leasing agreement. So the lessee rents the property to the lessor, and the lessor makes regular payments for a specified number of months or years to finance this investment. And also bank loans are a tool for long-term financing. So when banks grant credit for a long term, since they are more riskier, they have to assess the creditworthiness of their customers. Companies may also issue bonds or shares of stock. A bond is a promissory note with a fixed interest rate, contractual payments, and principal. And those interest payments for when companies issue bonds, the interest payments they make to the bondholders are tax deductible. Therefore, it is advantageous for companies since they do not pay any tax on these interest payments. Companies may also issue stocks to raise capital to finance their long-term investments. And stocks represent ownership in the business or its assets. When people buy shares of stock, in fact, they become owners of the company. So bonds, in fact, provide debt financing, whereas stocks provide equity financing for companies. Another important area of decision making is the capital investment decisions. We call this process, in fact, capital budgeting. So there are various tools for this purpose. When companies assess various investment projects and they need to decide whether to invest in the project or not, they utilize some tools so that they make sound decisions and the investment projects that they undertake create value and make a contribution to the value creation process in the company. Some of these tools are net present value, internal rate of return, and the payback period. The net present value shows the amount of wealth expected to be created if the project is undertaken. The internal rate of return, on the other hand, is the discount rate that makes the net present value of the project equal to 0. The payback period is the number of years needed to recover the initial investment outlay. So companies decide to undertake a project if the net present value is positive, or if the internal rate of return of a project is higher than the expected, is higher than the required rate of return of the project. And the payback period also may give us an idea about how long it will take us to recover our initial investment outlay. So we can make the decision to accept or reject a project by comparing the calculated payback period with some target payback period that managers determine. Since businesses operate in a risky environment and there are lots of uncertainties in the business world, it is very important for managers to manage those risks. In fact, in the area of finance, we define risk as the potential variability of expected returns, or the potential variability in the future cash flows. So we can classify risk in many different types of risks. One of the main types of risks we can talk about are credit risk, market risk, political risk, or operational risk. These are the main types of risks a business can face. The credit risk or the default risk is in fact the risk that the company will not be able to pay the contractual interest or principal of its debt obligations. So it is the default risk. The market risk, on the other hand, is the risk that the value of an investment will fluctuate because of general market conditions. Political risk is the risk that a country's government will suddenly change its policies. The operational risk is about risks that can arise from a company's ordinary business transactions, business operations. So when we talk about, when we consider risks faced by individual investors, we can say individual investors can reduce some of the risks they assume when making investment choices. They can form a portfolio of investments, meaning they can invest in different types of investment tools such as bonds, stocks, or corporate bonds, so that they can diversify some of the risk they take when making investments. In fact, a portfolio made up of different kinds of investments will yield higher returns and will pose a lower risk than any individual investment tool in the portfolio. As I emphasized in the beginning of the lesson, it is crucial for businesses to create shareholder value and maximize the wealth of their shareholders. So to sum up, this shareholder value creation process, in fact, consists of different aspects of decision making. So there is the investing aspect, the financing aspect, and the operating aspect. So we can say companies can create value if they can achieve economic returns above the cost of capital on their existing and new investments. So it is very important to make sound, profitable investment decisions. In terms of the financing aspect, companies should make effective choices relating to the financing mix to finance their assets. In other words, how much debt financing they must use, how much equity financing they must use, and the tools they can use in terms of financing, since they influence the profitability and riskiness of the company. And regarding the operating aspect of value creation, we can say businesses must offer the right products and services in a cost-effective manner so that they can gain competitive advantage and generate long-term cash flows to enhance value creation. Last but not least, I will be saying a few words about ethics in financial management. Ethics is a very important topic, especially in finance, because finance is about money issues. So people, finance managers or managers in general, may tend to be confused because of ethical dilemmas, ethical conflicts. So it is very important that businesses and managers comply with legal regulations to fight against these ethical problems such as fraud and corruption, and to prevent ethical scandals to maintain a good reputation for the company.